Hello, welcome to another episode of the Capital Employed podcast. Joining me in conversation for this episode was Michael Crawford from Chawton Global Investors. In this episode, Michael provides an overview of the TB Chawton Global Equity Income Fund. He also walks us through his thesis for investing in two companies which he thinks can keep on compounding away for many years to come. I really enjoyed listening to him, and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Also, if you are listening to this podcast on the Apple Podcast app and have a spare 45 seconds, it would be really appreciated if you could leave a review, as it helps us spread the word and the feedback is very useful too. Okay, on with today's episode. Please enjoy my conversation with Michael. Hi Michael, thanks for coming on to the podcast.
Hello John, and thank you very much for inviting me.
Can you provide an overview of the Chawton Global Equity Income Fund? What's the objective and the investment style?
The fund is the TB Chawton Global Equity Income Fund, which is a UCITS OEIC. The overall objective for the fund is to both compound the growth of income and capital. The fund was launched in May 2019 and is actually a global equity fund. And it's invested in around 35 corporate groups, so it's a concentrated fund. We have competitive fees which reflect our quite lean cost base, and also as a long-term philosophy that we have, which I'll describe. The fund has low turnover, which also limits the costs for investors. Turning to the philosophy, it's Warren Buffett was a big influence in my career, and especially early on. Therefore, what we try and do in the fund is identify and invest in long-term sustainable businesses, much as he has through his career. We have sort of 5 pillars that drive our philosophy. Firstly, we look to invest in companies that achieve high and sustainable returns on current capital invested. But we also look for companies where they also have opportunities to reinvest capital generated, with the high probability of achieving high returns on this incremental capital. We're particularly keen that there's an alignment of interest between ourselves and our investors and the company and the sort of power brokers behind the company. And we want to really feel like we are an owner of that company and act like that. We also, as I said, we're looking for sustainability in these businesses. And so we have certain criteria that we believe contributes to that over the long term. Financial leverage is a key risk. So we look for companies with particularly low financial leverage. And also we're looking for companies where there is a sort of culture of integrity, of high integrity. And that's often reflected in their attitude to sustainability, but also the way they treat their various stakeholders, the customers, suppliers, etc., making sure that value is appropriately shared. And finally, we also are focused on valuation. We also consider the margin of safety when we buy a company. We will estimate the value of a company. We want to see that we're not overpaying. But we also look at the potential of the company. We want to try and make sure that there is a pathway for the company to drive value over time. This philosophy has contributed to a good performance since launch. We are actually first quartile in our sector, IA sector, up around about 30% since that May 19 date. And also within that return figure, we distributed about 4p in dividends. referencing that off 100p opening offer share price. And the fund has been stress tested early in its existence, obviously through COVID. And we came through COVID well. As I said, our companies tend to have strong balance sheets. Often they will have low volatility growth, staples and so forth, and good yields. So we own, for example, Nestle and Johnson & Johnson in that sort of area. But also we do look, as I said, for good growth, companies with growth as well. So, for example, we own Microsoft and Netflix.
So if we can jump into your portfolio, can you talk us through two companies that you feel have a good long-term potential, and what was the thesis for investing in them?
Yes. In fact, we like to think about our portfolio as two sort of large segments, and I'll talk about one from each. The first is what we sort of call our income generators, and these are companies that tend to distribute a higher proportion of their earnings as they don't need so much capital to grow. And a good example of this is a company called Geberit, which is a Swiss-based industrial that supplies behind-the-wall bathroom plumbing products, piping products, and bathroom systems. You often see their brand in Swiss hotels. They have, I believe, competitive advantage through a number of aspects. One is they are very innovative in their engineering. They use modern materials. They're innovative in design, and in particular, they look for mechanisms of installation of their product and make it very easy for installers to put this product into buildings. There's also a sort of design aspect. I would classify their products as very sort of premium end of the market. So that this is all translated into a long-term track record of high return on invested capital. Now they actually market to as I said, the installers and architects more than the ultimate end user of a bathroom. And what they actually offer for these sort of gatekeepers is that they can, through this ease of installation and simplicity, and also the reliability of their product, they save time, which translates into greater margin for these installers. That proves a very attractive dynamic. They are the dominant provider in Germany and Switzerland, and now they're sort of expanding through the rest of Europe and into Asia. And they do have a small presence in the US as well, where they have a very high-end product there. So there's ample opportunity for the company to invest incremental capital at high returns on investment. The company has I regard it as a very unique culture of sort of modesty, integrity, and sort of typical Swiss engineering excellence. And this has really been developed through a series of sort of influential chief executives and a really excellent board of directors. So the incentivization is very aligned with us as long-term investors. It's very focused on return on invested capital in both the short, medium, and long term. And it rewards sort of steady growth, which is also value creating. So overall, Geberit doesn't actually require a huge amount of capital to generate its growth. So the company tends to distribute a high proportion of its earnings and yields well over 2%. And I anticipate this company to probably double over the next 10 years. The second example, which is in the segment of the portfolio which is more growth focused, is an example where, and in such cases, the company typically, because it has more projects to invest in, will retain a greater proportion of its earnings and therefore distribute less. An example of this sort of company is Progressive Corporation, which is the third largest automobile insurer in the United States, and it was founded in 1937. The company has competitive advantage through cost efficiency. It has a very lean cost base, and also through its profitable underwriting, where it has a very good track record. They're also known as an innovator within their industry, and in particular, they've deployed telematic technology to assess the capability of drivers, which then feeds into their premium. So they actually are very good value if you're a conservative driver in the US. These advantages are translated into a extended track record of high return on equity of around 20%, but also past growth over the last decade and even longer. Their distribution model is omni-channel, but they make very good use of the internet for distribution, which is also cost effective. They have developed close relationships with companies like Uber and Tesla as well. The common factor here being that both those companies are very interested in the collection of data on driving to help price insurance. They think that's the way forward. And Progressive has been a partner for these companies in that to that end. There is ample opportunity, I believe, for the company to invest capital and grow the business at similarly high return on equity. Warren Buffett actually commented in his recent AGM complimenting Progressive on the quality of their underwriting and market share growth. He is actually a competitor to them with his Geico operation. The final point is that, again, in terms of alignment of interests, I think this is really the company have an excellent culture of long-termism, and it's demonstrated through the way they approach their dividend. Although, as I've said, they tend to not pay out a huge amount of their earnings as a dividend. Every 4 or 5 years, they will actually pay a special dividend if they've built up a level of surplus cash to warrant this. And in fact, in 2020, when we had a very low claims environment for obvious reasons, they did declare a special of $4.90 a share, which translated into about a sort of one-off 5% yield. Again, I think this company has excellent long-term prospects.
Okay, thanks for sharing those two. Just out of interest, how would you deal with a situation if one of your companies that you've invested in starts cutting their dividend?
Well, I'm actually sort of very open to considering that in more depth, because perhaps as illustrated with the example of Progressive, I think it's vital that the management of a company actually does the right thing. As I say, if there are opportunities to invest capital at high returns on capital, my view is that should warrant a cut in the dividend. Equally, if the company has had some shorter term issues, as we saw with COVID, again, I think it's the right thing to act conservatively and cut the dividend. We did have a few companies in our portfolio who did that, as I say, and we supported that.
You've mentioned Warren Buffett a few times. Is there a person that you have met or followed, or even a book you've read that has made you a better investor?
Warren Buffett and Charlie Munger are great influences on me. But another book I think which is really important for all investors to consider is a book by Daniel Kahneman called Thinking Fast and Slow, which I think is very relevant currently. Up until Kahneman's work, and indeed this book, economic theory centered is really based around rational behavior, that everyone acted rationally. And he proved through a number of sort of hypotheses and experiments which are described in this book that this is actually anything but the case, that people have inherent biases and often act irrationally. And a few examples that are particularly sort of forceful, I think. But firstly, there is a tendency for people to believe what they've been most recently told, especially if that's been told in a very authoritative manner, they would accept that without challenge. And I think this is relevant today as we see sort of many stocks and other assets being propelled by convincing narrative. For example, we hear about sort of genomics being perhaps very challenging for the healthcare industry and blockchain being very challenging for the financials industry. And I suspect the truth is actually much more nuanced and much more sort of in the middle. But as I said, that seems to be a sort of heuristic that many investors are operating on at the moment. People also have an inclination to come to a quick, intuitive decision rather than consider detailed facts rationally. A good illustration of this is that very few investors will ever actually look at an annual report, but will accept an argument that simplifies the investment case. And I think the whole sort of current SPAC, special acquisition vehicle phenomena, is an illustration of this. Another example is anchoring off the recent past, and particularly sort of recent numbers. And again, I think this is where valuations can get out of kilter with the underlying economics of a company. We regularly see at the moment that a 10 times revenue figure is an acceptable valuation for a disruptive company, and without people really thinking what that implies in terms of what that company has to generate in profit. So those I think the book has many more examples, but it really it's really important, I think, because it helps you when you're thinking about the companies you invest in and companies you may invest in, not to get too influenced by what the share price does, what the current narrative is, but to really go into depth and look at the underlying fundamentals.
Thanks for sharing that book. It's a book I've heard many people mention. So where can listeners go to find out more about you and your fund?
Yeah, so the best source of further information is our website, which is at www.chawtoninvestors.co.uk. And on the website, we set out our philosophy, which I've touched on, details of the fund and how you can buy it. It also has a number of articles that both which I have written and other articles that have been published in the media, and also actually has a link to a TV interview. We also have pages on LinkedIn and Facebook, and in fact we're just launching a YouTube channel as well, all of these under Chawton Global Investors.
Oh, that's great. Okay, Michael, thanks so much for coming onto the podcast. It's been a pleasure to listen to you.
Thank you, John, and thank you very much for sparing the time.